Hey guys, welcome back to another video. Today we'll be covering the Chapter 3 questions from the Investment Banking, Valuation, Leverage Buyouts, and Mergers and Acquisitions 2nd edition textbook by Joshua Rosenbaum and Joshua Pearl. And this is a fantastic textbook covering a lot of the entry-level knowledge and techniques that are needed to enter into the investment banking industry as a student or first-year analyst. And it's a fantastic textbook for any intermediate to even beginner kind of students who want to really become familiar with the technical skills and valuation techniques that are used in the industry. And in Chapter 3, we're talking about the discounted cash flow model, the DCF model. And I've already provided quite a long video covering the discounted cash flow model. And in this video, we're really going to be applying the concepts that we learned in that video and kind of testing them out through some questions. So let's get started. So question number 1, which of the following is a current asset? A, goodwill, no. B, property, plant, and equipment. C, accrued liabilities, or D, prepaid expenses. And feel free to really pause the video and try out the question yourself, but I'm just going to kind of run through them and kind of speak to them. And for question 1, prepaid expenses would be the current asset, accrued liabilities is a current liability, property, plant, and equipment is a long-term asset, and goodwill falls under equity. So none of these would be a current asset except for prepaid expenses. So D is the answer. Prepaid expenses, which are payments made by a company before a product has been delivered or a service has been performed, are current assets. The other choices are long-term assets. Now question number 2. Calculate free cash flow using the information below. Well, the unlevered free cash flow formula, which we learned about in the video, really starts at EBIT, and then we take away tax from EBIT, earnings before interest and tax, and to get our net operating profit after tax. We then add back the non-cash charge of depreciation and amortization. We then take away capital expenditures, and then we take away any change in net working capital. So, for this example, we have the numbers right over here, and I can actually do them with you. So, looking at our after-tax EBIT, so we have EBIT pre-tax of $300. Our after-tax we multiply by that tax rate. We get $186 net operating profit after tax. We then add our depreciation. We then take away capital expenditures. You can see right over here, we're taking away capital expenditures. And then finally, we're taking away our change in net working capital to get a unlevered free cash flow of $201, or in this case, $201 million. So the answer to question 2 is C, right? So we calculate our net operating profit after tax. We then take away our capital expenditures and our increase in net working capital, and then add back the non-cash charge of depreciation of $50 to get 201. Okay. Question number 3. How long is the typical cash flow projection period? This is quite an important question, and I've had other videos. I made this video covering kind of the common mistakes that entry-level analysts and students make when building up a DCF model. And one of the common mistakes that they make is the horizon for which they project the free cash flow of a company. And from a theoretical perspective, the answer to this question would be C, 5 years. So typically free cash flow is projected for a period of 5 years, but it is dependent on the target sector, stage of development, and the predictability of its financial performance. It is critical to project free cash flow to a period in the future where the target's financial performance reaches a normalized level. And this is the steady state. So when you feel that if it takes 10 years for a business to reach a steady state of earnings, or if it takes 2 years, then that's really what the number that you're picking. If a business is very early on and is growing and earnings are going to continue to grow substantially, then it makes sense to project cash flows out longer and then kind of fill up the valuation gap with the terminal value method. But if the business is already quite at a steady state level, maybe it's a utility company, then you can kind of project it 1 or 2 years out and then use the terminal value to really project the remaining valuation. So it depends again on the business itself, but the average would be about 5 years. Question number 4. CAPEX and depreciation share all of the following characteristics except what? A, it is used in calculation of free cash flow. Well, yes, the unlevered free cash flow calculation includes CAPEX and depreciation. One is taken away and one is added back as a non-cash charge. B, it represents actual cash outflows. Well, one does. CAPEX represents outflows, but depreciation is a non-cash charge, so that's not really a cash outflow. C, found on the cash flow statement, both of them are, and then D, it's included in the calculation of property, plant, and equipment. That as well is true. So B is false. So capital expenditures as opposed to depreciation represent actual cash outflows and consequently must be subtracted from earnings before interest and after tax in the calculation of free cash flow. Okay, so B, so depreciation would not be a cash outflow. Okay, so question number 5, calculate the increase or decrease in net working capital from 2012 to 2013 based on the following assumptions. Okay, so these are the assumptions right over here. So accounts receivable increases from 325 to 350 from 2012 to 2013. Inventories increases as well. Prepaid expenses and other also increases. Accounts payable increase. Accrued liabilities increase, and other current liabilities also increases. So what we can first do is kind of first define the current assets and current liabilities. So the accounts receivable, inventories, and prepaid expenses would be considered current assets, and the accounts payable, accrued liabilities, and other current liabilities would be considered current liabilities. We can then sum up those values for each of the of 2012 and 2013 to get net working capital, and then take away. So the difference between current liabilities, non-cash current liabilities, and non-interest-bearing current liabilities is net working capital. And for net working capital in 2012 is $50, and then net working capital in 2013 is $65, right? And so the difference is there is an increase in net working capital, therefore there is a cash outflow, and therefore free cash flow declines, or a decline of 15 in this case. So the answer would be D from the options presented. So it'd be D, okay? Question number 6. An increase in inventory is A, a use of cash, B, a source of cash, C, no change in cash, or D, a decrease in property, plant, and equipment. Now, this is quite an important question because a lot of people get this wrong. So an increase in inventory is a use of cash because we're tying up the business's cash by purchasing inventory and holding it on our books. A decrease in inventory would be a source of cash because we're liquidating our inventory and increasing our liquidity. So an increase in current assets, and that's why when we look at net working capital, a positive, an increase between 2012 and 2013 is a use of cash. That's why we take it away. We subtract it from the free cash flow calculation because we're tying up cash in our current assets, because current assets is non-cash current assets, right? So the calculation of net working capital is non-cash current assets minus non-interest bearing current liabilities. So in this case, we're tying up our liquidity in current assets and therefore reducing the free cash flow to the firm, right? And that's why an increase in inventory is a use of cash, okay? So question number 7, an increase in accounts payable is, well, now this is easy, right? Now think about an increase in current liabilities. Well, in current liabilities, that means it's a source of cash because our cash is not being tied up right now. It's going to be paid off later, right? So it's a source of cash. It would be B. Okay, and so if you guys don't understand it, I have made 2 separate videos. I've actually made a video specifically on projecting net working capital and talking about that. And at the same time, I would recommend that you watch the chapter 3 video for this textbook. It's quite long, but you can watch it in bits and pieces, and it's relatively easy to understand once we kind of explain it fully. Okay, so question number 8, calculate the DSO ratio, assuming a company has $3.5 billion in revenue and $300 million in accounts receivable. Now, these are some of the ratios that are used to project net working capital. And essentially, the DSO ratio is accounts receivable divided by sales times 365, right? And so we can do that calculation. Here, I'll just do it just to exhaust the thing. 300 divided by 3,500 multiplied by 365 gives us about 31.28. So rounding down, it'll give us 31 days. The answer is C. And so the DSO calculation is calculated by dividing accounts receivable by sales and multiplying the answer by 365. Okay, and this ratio represents how long it takes for us to receive our accounts receivable. So the lower the DSO ratio, the better the company is in kind of making sure that customers are paying on time. Versus if the DSO ratio is increasing, then maybe our customers are having trouble paying our bills, and therefore we're not really receiving that cash, and remember it's an outflow of cash because right now it's being tied up in accounts receivable and we're not actually receiving it. So it's bad for us to have higher accounts receivable and lower cash. We want higher cash and lower accounts receivable. Okay. Question 9, which of the following is the most appropriate market risk premium to use in the calculation of cost of equity? We've talked about this. We spent a lot of time in the video. The answer is C, 6% to 7%. The market risk premium is the spread of the expected market return over the risk-free rate. Finance professionals typically use the Ibbotson to track data on the equity risk premium. According to Ibbotson, for the 1926 to 2012 time period, the market risk premium is approximately 6.62%. And so this market risk premium is used in the capital asset pricing model used to determine the cost of equity, and eventually which rolls up into helping us calculate the weighted average cost of capital, which we can discount the free cash flow of the firm in order to calculate the present value of the firm. And so this is a key component of the assumptions that are made in the discounted cash flow model. So we spend a lot of time on that in the video, and once again, I recommend that you do watch that video. Okay. Question 12, which of the following sectors should have the lowest beta? Well, remember, beta is, at the end of the day, if the market has a beta of 1, and if a company has a beta higher than 1, then if the market returns 1% and the company has a beta of 2, then the company itself, the stock, would return 2%, right? So it's relative to the systematic. It captures the systematic risk of a company, right? So unsystematic risk refers to company-specific risk, which can be eliminated through diversification. But systematic risk cannot be eliminated because at the end, every company in that respective market is susceptible to market risk, right? So really, the question is asking us which of these sectors is the least riskiest, right? So in this case, social media will be quite risky. Utilities are very safe. Home builders or chemicals, both of them are very cyclical. So it would be B. The utility would be, they have the lowest beta. So companies in the social media, home builder, and chemical sector are more volatile and riskier than companies in the utility sector. Therefore, a utility company should have a lower beta. Now, question 11. Which methodology is used to capture the value of a company beyond its projection period? Now, the long-term value, long-term adjusted value, terminal value, or projected value. Well, I kind of was talking about it when we were talking about, the weighted average cost of capital. The terminal value is the correct answer. It's C. The discounted cash flow approach to valuation is based on determining the present value of all future free cash flow produced by a firm. As it is infeasible to project a company's free cash flow indefinitely, a terminal value is used to determine the value of the company beyond the projection period. Okay. Question 12. How does using a mid-year convention affect valuation in a discounted cash flow model? We talked about this. We went through some examples. A, higher value than year-end discounting. B, a lower value than year-end discounting. C, the same value or not applicable. The answer is A, because we are we're raising it to the power of a lower number. The discounting factor is significantly higher, and therefore, our present value is higher than if we were to do year-end discounting. So the use of a mid-year convention results in a slightly higher valuation than year-end discounting due to the fact that free cash flow is received sooner. And so essentially, this assumption centers around how are we going to really discount our cash flow? Is cash flow all received at the end of the year, or is it received kind of in between throughout the year? If you're making that assumption, then you're using mid-year convention relative to year-end discounting. If all cash flow, and there's not really many real-life examples where the business receives all of its cash flow on December 31st, but you have to really make that assumption yourself. The banker has discretion at whether they want to do year-end discounting or mid-year convention discounting. Okay. Question number 13, using a mid-year convention and the assumptions below, calculate enterprise value. So essentially, this is kind of like a mini DCF. They've already provided the weighted average cost of capital, the discounting factor, and then at the same time, they provided a terminal value multiple. So we know what our exit multiple will be for EBITDA in 2017. So it's assuming that we're currently in 2012, and we have projections for 2013, 14, 15, 16, 17, and after 17, we produce a terminal value multiple to really calculate the enterprise value of the company. So I kind of did this in Excel, quick thing. So I put the 100, 110, 120, 125, 130. So these are the free cash flow numbers right over here. And then I inputted and calculated the discount rates based on the time period. So assuming mid-year convention, so then raised to the power of 0.5. So 1 divided by 1.1 raised to the power of 0.5 in year one. We discount it to 95 from 100. So for the present value, and we do that for all periods. So the sum of the explicit forecast period would be $459. And then we also calculate our terminal value calculation. So we look at the final period EBITDA in 2017. We look at the exit multiple of 7.5x. Now, the assumption in this question is that this is the best number to use, so we're going to use this. We multiply 7.5 times 250 to give us a terminal value of 1,875. Now, this number is the value in 2017. So we then have to discount that value using the same discount rate as in 2017 to discount it back to the present value of terminal value of 1,164 today in year 0. And then we add up those two numbers to get 1,623.7 million, and we can kind of round that up so that the answer to this question, the enterprise value of this company, is 1,624 million, or 1.624 billion. Okay, so why might perpetuity growth method be used instead of exit multiple method? So, there's the Gordon growth. I like to call it the Gordon growth method or the exit multiple method. So we just did the exit multiple method, where we look at an exit multiple and we calculate the terminal value. Now, another way you can calculate the terminal value is using the Gordon growth method, in which we assume a long-term growth rate. Now, why might we choose using the long-term growth rate over an exit multiple? Well, one, maybe it's the absence of relevant comparables to determine an exit multiple. Two, is it difficult to determine a long-term growth rate? Is C, the current economic environment is volatile? Or D, the target company is private? Well, it would be A. So there's an absence of relevant comparables to determine an exit multiple, right? So if there are no relevant comparable companies to determine an exit multiple, the perpetuity growth method or the Gordon growth method can be utilized to calculate a terminal value. The PGM is often used in conjunction with the exit multiple method, which each serving as a sanity for each of other. So at the end of the day, you kind of want to calculate both and determine if one is significantly off than another, then there might be something wrong. But at the end of the day, they should be within similar ranges, and therefore, you can calculate your terminal value and confirm and defend that assumption. Okay, and then the final question, question 15, why may a banker choose to add a size premium to the capital asset pricing formula? Well, I won't read them all off. At the end of the day, it's question A. The empirical evidence suggests that smaller companies are riskier and therefore should have a higher cost of equity. And I actually spent like 20 minutes. I made this whole video on cost of equity. It's probably one of my first videos because I'm really passionate about discounted cash flow models. Like this, I love discounted cash flow models. I love the theory behind it. I really love its use. I'm a big believer in the fundamental valuation that a DCF provides. I am a fundamental investor at the end of the day. Cash is king for me. And whenever I look at a company, I trust the discounted cash flow model first. And if they are unprofitable or it's really difficult to calculate free cash flow, then I move to more current market-based calculations like precedent transaction or comparable companies analysis. But the discounted cash flow model, there are a lot of assumptions that need to be made. And one of them, and the textbook really covers only the size premium, but there are a lot of others. There's also the geographic risk with regards to the company, and there's also sector risk. But the concept of a size premium is based on empirical evidence suggesting that smaller size companies are riskier and therefore should have a higher cost of equity. This phenomenon, which is to some degree contradicts the capital asset pricing model, relies on the notion that smaller companies' risk is not entirely captured in their betas given limited trading volumes of their stock, making covariance calculations inexact. And so essentially the regular capital asset pricing model is you take your risk-free rate plus the result of multiplying the beta times the market risk premium of that respective company to get your cost of equity. But with smaller companies, you can add a size premium. You can add an additional 2-3% risk that really represents that size, the risk of a smaller company. And there are a lot of other assumptions. It really depends on the banker itself and his or her experience on how to really make these assumptions and to connect the dots. At the end of the day, you're an investment banker or you're an equity research analyst, you need to defend your assumptions. That's key. Right? So whatever you do, you need to ask yourself, can I defend this to the very end? Or am I really stretching these results? So you want to make sure that you're confident in your assumptions and that they're defensible based on empirical evidence. Other than that, that's pretty much it for Chapter 3. As always, if you did not watch Chapter 3, I would recommend that you watch that video as well. And I produced Chapter 1 and 2 videos where I talk about comparable companies analysis and precedent transactions analysis. And in Chapter 4, I'm going to be talking about the leveraged buyout analysis. So there are tons of other content on my channel. I do recommend recommend that you check that out and subscribe to the channel. As well, if you're interested in buying the book, please do check out the Amazon link. I've provided a link in the video description where you can buy the book. As always, if you do support the channel and you found this video helpful, please like and subscribe to the channel for more videos, and I hope you have a great day, guys. Thank you so much.